Hello everyone. With me today is Yann Murciano from Blend Network, and I'm very pleased to have Yann on the show. Yann was
Yeah.
previously an executive director at Morgan Stanley, where he was working in the London office as global head of base metals trading for about 10 years. And prior to that, he was at the ABN AMRO team where he worked as an FX option trader. He's very well qualified. He holds multiple master's degrees, a lot of which are in finance and insurance. And about 4.5 years ago, 2016, I think you started Blend Network. So I'm keen to learn more about you and also Blend Network. So welcome, Yann Murciano.
Thank you. Hi, everyone. I mean, that's exactly right what you said. So, yeah,
Do you want
what are we
to give
interested
us
in
a little
today?
bit about you and well, a little bit about you, before kind of jump into the questions. I've got a lot of questions to ask you about
Sure.
Blend, but do you want to maybe add to your what I've said so far about your profile?
No, I mean, you're exactly right. My background is very much finance in the banking industry as a former trader, looking always for investment opportunities and finding how we can apply those skills in I'm not going to say better environment, but how can we use it to help a bit more the economy?
Cool. Okay, so let me jump into the questions. So I think is that right? You started Blend in 2016, I think, in around June time. Was that right? In the summer?
That's right. I mean, exactly. Straight after I left Morgan Stanley, I started Blend summer 2016. But really launched about a year after, thanks to get all the compliance in place and the
Sure.
platform, the software, and everything. And we officially launched in January 2018.
January 2017 or 2018?
18. It took about a year
18.
to get the platform up and running. We did a
Oh,
couple
wow.
of deals in 2017, more like friends and family to test the platform. And then when we were in a strong positions, we openly launched in
All
January
right. So
18.
so it took you quite a long time, to get through the compliance and the setting up part of it, which that's quite interesting. So just going back a little bit, what motivated you to launch Blend? Most businesses are started because there is a problem that the founder is trying to solve. So what was the problem that you were trying to solve when you launched Blend?
Yeah, that's exactly right. I mean, let me share with you a very short story.
Sure.
Why Blend came to my mind. I read at the time an article in the press. It was about a restaurant owner in France, where I'm from, in case you didn't get the French accent yet. But the guy basically had a successful restaurant, right? He sent an application for a loan to open a second restaurant, and he sent it to multiple banks. And after a few months, only one had replied and said no. So clearly, to me, that's probably came to my mind the most. And so there's a problem in lending. Since 2008, basically, the banking industry has changed and the access to credit has really changed. And I thought there was an opportunity. There was an inefficiency in the market. Well, people have great businesses, wants to access finance, but for some reason they can't. So I looked at the peer-to-peer model, which I really liked, which to me is about connecting investors really with lending deals, basically. Um, Consumers was out of the question for me very quickly because I was not really keen lending myself to consumers. So what was
Mm.
interesting was really the SME market and the property market. And I thought both are good, but as a investor, the risk reward on property deals backed with an asset, a hard asset, is a lot more attractive than an SME, which are going to be at similar rates or even slightly lower, but backed with a
Yeah.
debenture, which doesn't really worth much in a default scenario. So that's where the
Yeah,
idea
because
came,
there's no
and
real underlying asset there, is there?
exactly. So as an investor, it's a no-brainer that to me property was first more attractive. And two, I mean, you have a housing crisis, right? I'm sure you heard the government talks all the time about
Mm.
the need to build 300,000 new houses per year, and we're not reaching that. And I think big issue is access to finance for the SME developers, SME developers. It's more difficult to borrow probably £1 million or £500,000 than to borrow £10 million. And that's where the idea of Blend came from, really.
So that's interesting. So, you know, do you think that there's more issues for SME property developers, and on the back of that, you know, in terms of, you know, finance or access to finance, and on the back of that, do you think that SME property developers are an important part, if not the key, to solving the housing crisis in the UK?
Yeah, I mean, two part. Yeah, for sure, the SME developers struggle more to access finance, I think, because you get a lot of institutions who are lending and doing development finance, but because they have billion or multi-billions of pounds to deploy, they have no interest to do a due diligence on a small deal. So it becomes more difficult to borrow money when you have a smaller deal and a bigger deal. And yes, on your second part of the question, definitely that's how you solve the problem, because what the country now needs is not building big buildings in London. It's more about building 20 houses there and 30 flats there. It's really having small pocket of developments in the regions all across. And those developments are too small for the big lenders, for the institutional lenders. And they need to access finance to be able to do those deals. So clearly, I think that's definitely the way to solve the problem. And we see it every day. We see developers who sometimes fund with their own money the project, or friends and family, so they cannot really scale their business. And what we tend to see as well, developer wants to build 12 houses, but he's going to build phase it in 2 houses and 6 phases, because he doesn't have enough cash to build at the same time. But he rather pay a little bit more on the cost of finance to be able to build the 12 at the same time, and then make a profit after 15 months rather than wait 3-4 years.
And I've noticed, you know, the interesting point that you make there. You know, a lot of your deals or loans have been focused in areas outside of London and the southeast. You know, you've done stuff in Scotland, in Ireland, in north of England. So not a lot of that is, you know, exposed. Was there a conscious decision to go out into the regions rather than London and the southeast?
Yeah, definitely. I mean, we were very strong initially on outside of London, but anywhere in the regions when we started the business. And the two reasons was, one was Brexit. So I think now actually we'll be more comfortable doing London than 2 years ago, because the uncertainty environment is not where we were 2 years ago. You had stamp duty as well, kind of hit a little bit London as well on top of that. But the region is clearly where there's a lack of supply, and a lot of developments we've done in outside of London has been sold off plan because there's demand and there was a lack of supply. So for us, the strategy has been the regions and the regions and the regions for a while.
So, I mean, you know, Blend's been going now, I mean, from when you kind of started it, you know, I appreciate that you kind of fully went live, so to speak, in January 2018, but from the summer of 2016, so, you know, has your vision and goals for the business evolved or adapted somewhat as operations have, you know, evolved since 2018?
I mean, we always evolved for sure. I mean, just the strategy, for example, I said we did not touch anything in London to date. Now I think we'll be more keen. There's always small involvement, but the big picture, it hasn't really changed. If anything, with the pandemic and the economic crisis we're seeing now due to the lockdown, I think it justifies even more than before the needs of platforms like Blend, because access to finance is not going to get easier, and the economy needs access to finance to recover. So definitely, I mean, if anything, we're even more and more confident that the economy needs a platform like Blend.
Yeah, absolutely. And I think also, you know, from your other side of the customer, or one side of the customer base, in terms of lenders, they need a place to park their capital because they're not getting anywhere near a decent interest rate on their capital with the banks, who themselves since 08, 09 have not really been lending to the SME property development sector, and where they do, there's a lot of friction. So there is certainly a need, I think, for the high net worth individuals, family offices to park their capital somewhere which gives a double-digit return. And I think your network is averaging about 11.6, 12% rate of return at the moment.
Yeah, that's right. I mean, the rates actually, I'll be honest with you, is coming up slightly because we kind of have reduced a bit our credit policy since the beginning due to the current environment. So we're more into the 8 to 10% per annum at the moment. But clearly, it's a great product for those type of investors because they're looking for yield. It's very difficult to achieve yields in the current environment. So obviously, we know what you can get at a saving account. The equity market has done really well if you bought the lows this year, but it's a different type of risk and different type of volatility. And a couple of other things. I mean, obviously, you're behind. You can lend after us, after our own due diligence that we've done. Maybe we can talk later about that, but we've done a really strong due diligence on every deals we list on the platform, which can give confidence to someone who's less experienced is going to miss some of the points. Plus, a ticket of developments, let's say of £500,000, £1 million, quite big for one single investors. Even if they're going to have multiple investors on one project, you're going to have, without a platform, you're going to have 2, 3, 4, 5. So the minimum entry ticket is going to be quite high. And even if you can afford to invest £250,000 on a single ticket, that means your diversification on project is going to be a lot smaller than a platform like us, where because of the technology, we can syndicate the loans in £1,000 loan part. So you can invest £1,000 on a loan, you can invest 7,000, any amount in multiple of 1,000.
Yeah, and then diversification is quite important. I think we'll come back to that in a little bit. But let's go back to the kind of the start. So let's say I'm a SME property developer, and I'm thinking about raising for the first time in a lot of cases, funds through a crowdfunding platform. What is the process? Talk me through the process with Blend from the initial inquiry. They pick up the phone to you, or there's an email that comes through from your website. What's the process like?
Sure. So the first part of the process would be to send us an appraisal where we can see first what's your experience and who you are, what you're looking to achieve. You're looking to convert an office into residential. You're looking to build 10 new houses. What's your project? Second, we're going to look at, does your project stacks up? Meaning what's the purchase price of the site you're buying or the property you're buying? What's the build cost? What's the contingency, professional fees, any seal or section 106? So we look at their profit in it. Is your GDV stand up? Like we see some deals sometimes where people are unrealistic about their GDV, or is it too conservative? So does it make sense? So if we think you can deliver the project and the project makes sense, then we should be in a position to basically offer you terms. So as soon as we receive this, within 24 hours, most of the time same day, we issue terms to the developers. Developer is happy with the facility, so I want to go ahead. Then we immediately instruct a valuation report. We start our full due diligence process, reviewing planning and all the things. I'm sure Tariq as well on the project. So reviewing the experience, we do all the property work. We instruct the QS report,
and all of that is done. All of that is done in-house. Sorry to cut across you yet, but all of that is done in-house by your own team.
So it depends. The risk valuation, we want independent risk valuation. Otherwise, there will be a conflict of interest for our lenders. Okay. So we have independent QS and independent risk valuation, and the legal team independence. But then our guys in-house will perform all the due diligence, and we have people with very strong experience in property. And Paul, who runs the origination team, used to work at Octopus and JLL and RBS Real Estate. Danny was a property developer himself, well, very strong experience in property. They will do the due diligence.
Right.
They will prepare a credit report. They will review everything. Then they present the project to the credit committee, which is Charles Lamploff and myself, and the credit committee is more finance experience. So Charles was at Lloyd's Bank for over 35 years, so very experienced guy. We review a deal, it's approved, goes on the platform, gets funded very quickly, and that's something we might discuss later. But lenders sometimes
Yeah,
miss
no,
on opportunities.
yeah, so that's quite interesting because you said that you issue initial terms at least within 24 hours from the inquiry being received. So just on that, I mean, do you guys have a sort of standard application form that you work to, or is it whatever the developer produces by way of a deck that you guys work off?
Initially, we're happy to receive the information from the board, and sometimes between you, it's quite interesting to see how the board presents, because a more sophisticated developer is going to present in a better way than a less sophisticated. So it's almost information already at this stage on the type of borrower. And then if the terms are accepted, then we're going to send a list of documents we need in a specific format. But initially, we're happy. We don't want to give too much work to the borrower in case things don't work out for him. It doesn't suit him. We don't want to ask him. You know what's horrible is when you go to like a bank and you want some information, you're gonna wait 2 hours and fill the 36 pages before you get your answer, which actually they cannot do at all. So we try to be a bit more efficient.
That's a common frustration amongst SME property developers, I find.
So we try to be a bit more efficient in that way.
That's good. And so, okay, so they present that, and then you ask for more information, and then roughly about 20, I mean, assuming that they've given enough information, roughly about 24 hours, they get indicative terms. So from broadly speaking, from that initial inquiry to the point where money is actually transferred into their account in order to fund the deal, how long has that process roughly or on average taken in the last few deals?
Right. So in theory, which happened in the past, it can take 4 weeks because you take about a week to get a valuation report, a week to get the QS. We do our work in parallel, and then 2 weeks in legals. That's quite standard. The money doesn't take time, or it's in parallel. It's not extra time to raise the funding. And most of, I think last year the longest it took was in May, in the middle of the crisis. It took 3 days to raise the funding. But everything otherwise was within hours, if not minutes, if not seconds sometimes. But in practice, I'll say quite often it takes 6 weeks or even longer, depending on the developer, because we get cases where the developer comes, he got terms, is accepted, but actually he wants to change the planning, and then it's out of our control. So if someone is ready and presents and has the information ready and has good solicitor who can be replying very quickly, it can easily be done in a month. But in practice, we tend to see there's an information missing, and the board will take from a week to anything to get the extra information. So that really depends on the board how if he's really in a rush. If they're really in a rush, we can be very quick, but it depends on them. We try to, as soon as we receive the information, to reply very, very quickly within 24 hours.
So that kind of brings me on nicely to the other question I wanted to ask you. So from your experience, what should a SME property developer who's coming to you to raise funds do to ensure that their crowdfund raise is going to be successful and also quick? So from your experience, what has worked pretty much? What's been good so far?
Yeah, the good thing I'll say, we're not gonna ask extra things to a borrower than another lender that is not a crowdfunding platform. We will ask exactly the same thing. Now, the reason you get funded quickly is because we've built a track record and a reputation. Because we built a very strong track record and a good reputation, the lenders are following us and wants to invest always more money, and we always have more lenders. So I'll say they more rely on us to have done proper due diligence on the developer. And because we've done every time a very good due diligence on the developers, and we've rejected a lot of deals that we didn't think stacked up, they follow us really. And once what we tend to see is when they've lent to a developer, and the developer has repaid on time and the project went according to the plans, then on the second deal, they want to follow. They become a bit like the followers on Instagram or whatever these
Like
days, where
fans,
it's
yeah,
exactly fans who say, "Oh, I've invested with this guy. I want to put more money because he was very good
yeah.
the previous time." So you're gonna have the new lenders plus the previous lenders who's gonna keep following and wants to invest in his project again and again and again. So yeah, you don't have to do
That's
any
that's a,
extra
that's an
work.
interesting point. That's an interesting point. The founder of Metro Bank
Mhm.
wrote a book quite a few years ago, and he the premise of his book is pretty. I mean, the book is actually called "Fans, Not Customers," and I think that's kind of what we're getting to. If you build a business that really takes care of the customers, then you can easily turn them into fans, and then from there, it's very easy to then sell whatever you're trying to sell. In this case, if you're trying to raise funds, then it's going to be a lot easier to do going forward.
Yeah, and it's exactly right what you said. I mean, to be completely transparent with you, we don't even spend much on marketing because we much
Mm.
bigger believer like build a customer service track record and good reputation is actually bringing people to the platform without us needing to spend a huge amount of marketing, and that's our strategy. It takes probably longer term more time to develop because to get known and everything, but that has been our strategy since the beginning, and we see it. A lot of our investors are repeat and come back on multiple projects and happy to invest, and then they even tell their friends to invest, and that's been a big part of the strategy.
Yeah, I have to say, I mean, that's certainly reading through your Trustpilot reviews. That's been a common theme that I've seen on your reviews. A lot of the borrower developers and also a lot of the lender investors have said that the customer service has been a very good experience for them. So I think well done on that, and I think
Thanks.
long may it continue. I think certainly for SME property developers, the experience that I found amongst my clients is that. The customer service experience with more traditional banks in terms of lending has not been great. And we understand that maybe the appetite is not really there since 2008, 2009. But if that's the case, then just be frank and say, look, we're
And
not really interested in lending in let
it's
people move on.
exactly right.
That's fine. So now,
Back to
okay,
what you were saying, sorry,
so
2 seconds, but we
sure.
exactly what you were saying just before. We think the borrower is a customer, and that sounds stupid, but
Mm.
that's a big thing. That makes a big difference. We think we treat the borrower as a customer, and we're going to be partner with them because we're going to be lending them money. So we only interest our lines, and I think quite often with lenders, it can look very much adversarial, which we don't think is the right relationship to have with a property developer.
Yeah, I agree. I think being a property lawyer, we come across this very often, and it's uh, and it doesn't get you anywhere. If you're much more collaborative, you will get the deal across the line much more quickly, and everybody will finish the deal on happy terms and wanting to do more. So I think I certainly agree with that. Now. Uh, One of the things that with crowdfunding is that individual lenders can question borrowers about the loan itself in the forum, right? So you post a deal on the Blend network, and then within the forum, if you're interested lender, you can ask some questions about the project and what have you. Now, um, uh, in fact, one of my SME property developers had raised a few months ago some equity through a different crowdfunding platform.
Mm.
I know Blend only does debt, but they raised some equity on a different crowdfunding platform. And what was quite interesting was that I think some of the individual investors had some fairly simplistic questions. So, and there
Mhm.
was, from memory, I think over 50 or 60 individual lenders. And so there were some of these very simple, basic questions that needed to be answered, which was a little bit frustrating. What are some of the more common questions that you've seen your lender customers, asking in the forums? What's sort of the common theme?
So first thing, couple of things about what you said. When people ask a question, lenders ask question, they ask the question to Blend rather than directly to the borrower. and we answer them. If we cannot answer them, we can ask obviously the borrower and share the information with everyone. But because we've done literally the due diligence before, I can't remember the last time we had to go to the borrower to ask the question, because we always have the answer because we've checked. We can always, someone can always ask something obviously we didn't think about, and we can ask the borrower. But I honestly don't think in 2020 there was one question that was raised we didn't have the answer. Now the question we get, I mean, it's quite wide obviously, because we have a wide panel of investors, from retail investor to high net worth family offices. So different type of people have different type of questions. Usually what we tend to see is people asking questions when they invest for the first time, rather than specifically to the project. So how does it work if the loan goes in default, or how does it work? When do I get repaid? What happens if I get repaid early? More generic questions, I'll say. The way we do what we do, and again, we don't have that many questions. I think this is due to the information we share on our platform. So once you're fully registered on the platform and we've approved you, so we've done the KYC and AML checks, you have access to full information on the deals on the platform. So we prepare a credit report that is shared with every investors, and all the information is there. Like, what's the experience of the developer? What are the costs? What's the GDV? Where is it? What's the population? What's the profit? What's our cost? We're completely transparent about everything, and that answer already pretty much all the questions. So that saves us time as well. We spend quite a lot of time having very good detailed reports, but that gives information to the lenders about the deals.
Cool. Okay, so I mentioned about the Trustpilot reviews, which are all very, you're averaging about 4.6 on your Trustpilot reviews, which is fantastic. One review that I spotted was actually quite interesting, and I'd like to sort of read it out for you just to give you the context, and then we can maybe try and discuss it. So the reviewer here said, only automatic investments are allowed, and to do so, you need to have a budget available. When your budget goes to zero, you go back to the investment queue. And if people above you in the queue decide to invest heavily, i.e. more than the £1,000 minimum, or the available loan opportunity is small in value, your chances of investing are pretty slim. So you're forced to keep money on the platform. And actually, the reviewer is quite good. They actually made a suggestion on the back of that comment, which was, it would be nice if the amount to be invested is capped. So this, in effect, if you're an investor, there's a maximum amount that you could lend through the Blend network, is what this reviewer is suggesting, especially loans requiring small amounts, he says, so that people down the investment queue can get a chance to get involved, or even better, if the auto invest mechanism is set on invest proportionately to what is your available budget up to the set maximum. Now, you've written a number of times in the past about democratizing the lending process, and that's part of the motivation for having Blend and peer-to-peer lending generally. And it appears to me there's an inherent unfairness in this approach if there's no cap. You're wanting to lend, but your funds are not being able to be deployed because somebody else in the queue has, or somebody else in the pool has taken up most of that loan amount. Because I don't see a lot of your deals, unlike other platforms. There isn't a oversubscribed option, I think, in your platform. So what would you say to that? In terms of that suggestion to have a cap in place.
Yep. So a few things on this. First, sorry to correct you, but the Trustpilot review score is not 4.6, 4.8. We're quite proud of that.
Apologies, yeah, sorry. No, even better.
Oversubscribed. We cannot be lending more than what's required on the platform first, obviously. Otherwise, that will increase the loan to value, which will increase the risk to our investors. So when there's a requirement to borrow to fund £500,000, we're never going to give to the borrower more than £500,000, even if there's more investors who want to lend more. Now, in terms of having money on a platform, you're right. Deals have gone very quickly, and you use the word. I think it's in this review. We force people to have people on the money sitting on the platform. We don't force anyone to have any money. It's their decision if they want to invest or not. But I think what we've been and more recently, probably victim of our own success, because we had very good track records, and people wants to, and even despite the current environment, we had a lot of loans repaying in December and January. So people have cash on the platform who wants to invest. We have new investors every day registering on the platform who wants to invest. And at the same time, we've been very cautious on the deal we accept to fund. So clearly, you're right. There's an imbalance today between the number of lenders we have and the number of deals we have on the platform. We could accept more deals to fill those interests, but we don't think it's the right thing. We're going to keep doing the right thing by selecting the right deals that we want to fund. Now, the challenge we have is treating customer fairly. For us to date, and it wasn't an issue because loans were not, we didn't have that many people for a loan in the past. We adopted first come, first served, which is the same rule for everyone and is treating customer fairly. We could change that to some couple of things you have suggested, which is, for example, getting a percentage. So you want to have £1,000 and everyone gets a percentage. Everyone gets filled, but in a smaller percentage. The problem is, what we found, this might not be ideal. Let's make it extreme. And you want to invest £1,000, you might think, okay, well, if we all get a percentage, that's fair to everyone. But let's say you end up lending £50 because it's way too many lenders. Would you find that? Would you be happy with that? I think every lenders would be unhappy because nobody, someone who wants to invest £100,000 on a deal and end up with £1,000, someone wants to with £1,000 end up with £10, 50 quid, they're not going to be happy. So that's a possibility, but you could have more unhappy people than just the people who miss it. Then you can have a cap. Let's say a cap of £2,000 or £5,000 or £1,000. Let's say you have a cap of £1,000. That would be good in democratization even more that we've done. We still believe we're really helpful in democratizing those deals because obviously you don't have to invest £250,000 anymore. The risk is you are missing on a deal. Problem you have if you cap at £1,000, you're going to lose all the bigger investors. While we don't want to lose the smaller, we don't lose the bigger as well because the biggers help us to onboard bigger deals. And by onboarding those bigger deals, we can offer them to smaller investors. So everyone is important. So what we're trying to do is keep everyone happy. So today, really, if you want to lend with Blend, on the bigger deals, everyone's going to invest because if we put a deal of £1 million, AutoLend will be fully invested and you're going to have a lot more people investing manually. But when we have a smaller deal of, let's say, like we had last time of £200,000 or £250,000, then technically there's like a queue. That means on the first deal and maybe the second one, you're not going to invest because it will be funded by the first one that are in the queue. But every deal we list on the platform, people who have invested on the last 10 deals are out of cash, and they're not going to invest on the next 50 deals. They're going to invest on the first 10, for example. Once they're out of cash, and we see that every time we put a new deal, you go up in a queue, and then you invest on maybe not the first and second one, but you're going to invest on number 3, 4, 5, 6, 7, 8, 9, 10 till you're out of cash. So currently, there could be a queue to enter the platform, which is not going to be 6 months. It's going to be sometimes, if it's a bigger deals, immediately you can invest. If you're looking to invest on smaller deals, it could take 2 weeks to a month. But that's being victim of our own success. We prefer to have the balance that way than to have deals not getting funded or bad deals on the platform. So as I said, it's being victim of our own success. Now I'll say what we really focus. Sorry, I'm going to finish because that's actually quite an important point. The best way, I think we're going to resolve that point, and that's what we're doing. We doubled our lending team since December, and that's what we're going to solve the problem. Is our appetite has grown. Let's bring more deals, same type of deals, but more on the
bring
platform.
more deals onto the platform.
Then the same type of quality, but more deals on the platform is going to solve the problem. Because whatever rule you change, the rule might be better for you. The new rule might be better for you, but not good for the high, less good for the other guy who was landing before. And
I agree
everyone
with
you
that.
change it, it's very difficult to. It's impossible to be perfect on that. But
No,
the best way to
absolutely,
be, the
absolutely.
best way to feed everyone is bring more deals.
Absolutely, I agree with that. So that kind of nicely brings me off to the next question I had for you, which is what is, because there is a limited number of deals that's on your platform, and they're funded very, very rapidly, also because of the auto invest function. So really, as as you've been explaining, the trick is to have a lot more deals on the platform. So talk me through some of the issues that your origination or BD team are experiencing at the moment. Why aren't more deals coming onto the platform for lenders to invest in?
I think, it's because with the due diligence we do and the selection we do, we cannot accept more deals because there's more investors. So we're growing at the right pace. We don't want to be scaling like crazy and then putting the criteria down and bring deals at default later. So we're doing our best to select the right deals. And as I was saying before, like we grow our team recently. I'm going to keep growing the team to bring more deals on the platform. But what we don't want to do is basically lower our criteria just to bring more deals on the platform. If we had to get some criticism, I'd rather it's, I wanted to invest and I missed on that opportunity, but I invest on the next one, than the other way.
Yeah.
And that's how we build the business. We're not a tech business. We think we're fintech, but there's credit, there's fin into it, and it's very important is the credit part. We use the technology to democratize the deals, to syndicate those deals into smaller tickets. But the credit part is very key, and I think if we're going from lending X to 20x next year, it will be we're doing something wrong. So it has to grow at the right pace to do it right. But
Absolutely.
the lenders are coming quicker than we expected, to be honest.
Yeah, I think that's reflective of the state of the the savings interest rates. So they're looking for a different place to sort of park their funds in. I think this is a great opportunity. So now just switching focus a little bit to the actual SME. A lot of my clients are SME property developers, and when I've had conversations with them who are not accustomed to crowdfunding and raising funds that way, there's a perception amongst them that crowdfunding finance is expensive. Some of them have said to me, "Oh, they charge 5% as an arrangement fee, and the interest rates are quite high. It's quite an expensive way to raise funds." Talk me through, how do you respond to a belief system or comments like that, and also in terms of specific, what actually is your cost schedule like?
Happy to be very transparent. In terms of fees, it's going to be very similar to the challenger banks who are in the market in development finance. We charge usually 2% arrangement fee and a 1% exit on a development deal. On the bridge, we'll waive the exit fee. So that's very similar, I guess, to the other traditional lenders who are lending in this market.
Yeah.
In terms of interest rates, obviously it depends of multi-parameters, loan to value, experience, location. We have our models running to determine the pricing, but usually we're going to be around 10%. So it's not expensive. It depends on what you're pricing, I'll say. If you go with a challenger bank, I expect you're going to get something around, you tell me you probably work with some challenger bank, but probably around 7%.
Yeah.
And I will say, if you can get it at 7%, get it at 7%. Now, sometimes why do we justify that we're a bit more expensive? There can be multiple things. One, gearing. Often we can lend you more than what the bank will lend at a cheaper price. And that's a very important point, because that's where you're going to increase your return on equity. So sometimes paying an extra to 2-3% on the interest rate to put less equity and to get a much better return on equity is a game changer for the developers, and they might be able to do 2 projects instead of 1 because they can get more gearing. Flexibility, if the challenger bank says no, what do you do then? What's your next option? The fact that they say no, clearly you cannot get it at 7%. We might spend a bit more time trying to understand the project and structure the project in a way that works. So we'll charge you a bit more, but obviously there's a price for the flexibility. And third point, we as we discussed before, we can do it very quickly, and that's the value to the developer, because sometimes you got to complete quickly to get it at the right price. If you can complete quicker, you can maybe negotiate better, and then again, an extra 2-3% on interest rate becomes totally irrelevant. What we tend to say to our developer is, you build with funds, so you focus on the building part and the project, and we help you with the finance. And the level of service is really a different level. I mean, the guys in the property team, I see them on WhatsApp all the time, even on the weekend, trying to help the property developer to complete, because the developer has maybe exchange and he needs to complete on the 17 and everything needs to be done. They will take everything they will do everything they can to get everything ready for the date to be funded. And I don't think many lenders really act like that.
No, I agree with that. I think, based on your reviews and the process that you guys follow, and also the combination of the auto invest function, you can get deals funded very, very rapidly. And I think for a lot of SME property deals, either a combination of the developer has offered speed in return for a reduced price, or there's a lot of interest in the site because it's quite a good development opportunity. The developer has to act quickly. And what I found sometimes, and I've blogged about this, which is how we connected, is that there's a lot of friction in the credit underwriting and also legal process with some of the more traditional banks. And as a result, there's a lot of grief, really is the only way I can express it, because a lot of my SME property developer clients have said that there have been multiple times during the credit underwriting process and also the legal process, once they've gone past the credit underwriting into the legal process, that they've actually felt, I don't think these guys want to lend to us. So why don't they just come out and tell us, instead of beating around the bush and making things more and more difficult? And I think that change in mindset is very very stuck. I think from what I've seen from your perspective and generally within crowdfunding, is that there is a real desire to lend to the SME property developers sector, unlike more traditional banks. And I think really SME property developers need to factor that into their business model, and also the costing is not just about the rates and the fees, but also the ease of lack of friction of getting the deals over the line.
You're right. And I think you touch a point that's quite important as well, that a lot of lenders are not regulated. I'm not talking about crowdfunding, but like bridging lenders and stuff like that. And because they're not regulated, they have a lot of, they call their sales guy the BDMs against the credit team. And it's very two departments in their companies. And the sales guy will say yes to everything, cheap rates, get the business lock the business, and then change the parameters and the pricing across during the due diligence with the credit team or the credit committee. We think it's very important to get a reputation. So what we want is, we always deliver what we promised from day one, as long as the board gave us the right information on day one. And that's the key thing, because if you're going to tell to the developer a month later you're not going to lend anymore, because you just wasted his time. But as a business, I think it's wrong. You also wasted the time of your guys, and you wasted the time of you're gonna have and that's probably what we discussed earlier, but an unhappy customer that is gonna have trouble because he's gonna miss his opportunity. Plus, he's gonna create a bad reputation and not come again. Whereas a happy client is gonna come again and tell the other developers about it and bring you more developers.
And also, I think, on a bigger picture perspective as well, if it's the new SME, or let me put it this way, it may be an experienced SME property developer, but coming to peer-to-peer lending to raise funds for the first time, and they have a bad experience in that way, they're probably not likely to come back. They'll just stick to the sort of traditional routes to funding, which would be a real shame for the sector, if that's the impression that developers are left with, that it's as bad as the other guys. So I think you guys are doing well, as evidenced by your Trustpilot reviews, that you're doing your level best to help SME property developers to succeed in this sector. Now, Jan, um, let me ask you something about uh, is secondary markets, right? So one of the downsides about crowdfunding is there is sometimes a perceived lack of liquidity, in the sense that if you invested your funds, or lent your funds on a project, your capital is tied into that. Unlike the equity market, there's a lot of liquidity, you can buy and sell relatively easily. With crowdfunding, there's much less liquidity, and with some crowdfunding platforms, they don't even like to create a secondary market. Secondary market here, let me just briefly explain, is where you create a second marketplace to allow lenders to exit their initial investment or loan by selling their stake to another prospective investor or lender. A lot of platforms don't like to create a secondary market, because there's this perception that if you do, you're undermining the credibility of the project or the loan, because why would a investor or lender want to exit early? Why don't they just stay in for the whole project? Um, but you guys, don't subscribe to that. You do actually have a secondary market, and so if a lender wanted to exit earlier, they can. There's a small fee. I think it's 0.06%. Correct me if I'm wrong, but they
20%.
can exit. So how does that work? And is there a long time to wait for a buyer to exit you?
Yeah, so talking about the secondary market, I think it's a great tool, obviously, for investors to be able to exit if they need to, assuming the loan is performing, obviously. Otherwise, we don't allow, if a loan was not performing on the secondary market, we're not allowed to trade on the secondary market to protect buyers as well. But I think it's a great tool. Now, we don't guarantee the liquidity. It's between the investors. To date, I mean, the loans are trading very quickly on the secondary market. I mean, I don't have the statistic on top of my head, but I'll say most of the loans have basically, who have been listed on the secondary markets, been exited within 48 hours. We actually have received an award on our secondary market, because I think it was like the fast-paced secondary market in crowdfunding. So I think it's a great tool to have. Obviously, we cannot guarantee the liquidities between investors on the platform, but I don't know anyone who wanted to sell. I don't think we had anyone who did not manage to sell on the platform. Yeah, it's a great tool. I mean, people's situation, you said it doesn't create a good image of the loan, because people might think if they're selling, something is wrong with the loan, but I don't think so. I mean, people, every investor on our platform have the access to the same information. And so if the seller knows something, the buyer should know it. Otherwise, we don't allow to list it on the secondary market. And some people in situation change. Someone lend for 18 months. When you do that, if you're going to lend to an SME directly, I'm going to be locked in for 18 months. But for some reason, I need my money earlier. The great thing with the crowdfunding is I can offer my loan to other investors of the platform. And that creates additional value to our model, I think. So I think it's a great tool to have.
Absolutely, I agree with that. I definitely agree with that. And now I've worked with a number of private lenders, private bridges, and over the years. And one of the concerns that I always have with private lenders, although they're high net worth individuals and they're sophisticated, sometimes I warn them that look, you're lending to a SME property developer. If things were to go pear-shaped, you would need to enforce the security. You might get, first charge and PGs and debentures and the whole deck of security, but you still need to enforce the security if things were to go pear-shaped. Now, what is your infrastructure like? Do you have processes in place to detect if a debt is going to go south? If and if it is, then what is your do you have a power team in place in terms of litigators and what have you to enforce the security? How quick is that process? And do you have the appetite for it as well? And have you factored in that cost to what the impact is going to be on your business? And a lot of lenders, I find, don't evaluate that risk as part of their business operations. And as a result, actually, their exposure, the interest rate might be high, but actually the real rate of return could be quite low. You just need one or two really bad debts to go really bad, or sorry, loans to go really bad, and then you could potentially even be wiped out. And a lot of private lenders don't recognize that risk. And I think actually lending through a crowdfunding platform removes or at least mitigates some of that risk. Your capital still is at risk. It's not covered by the financial compensation scheme, crowdfunding, but you're leveraging the platform to enforce. So talk me through that process. First tell me, how many of your loans have gone south, and also what your processes is like, and how quickly do you guys respond?
So yeah, on this, first to go straight to your the end of your question, we've done 61 loans. One has gone bad due to the corona. It wasn't a development. It was we've lent to an SME business, secure on land, and with corona, his business went. I mean, it was a great loan, which we priced actually was on the highest range of our pricing because we thought there was a bit more risk on that one. But the loan was performing for 18 months, and with corona, the business got in trouble. So we spent quite a lot of time. We spent a few months to try to find a solution because it was corona. We didn't want to be sharks and be appointing immediately because I mean, unfortunately, it was more macro risk, I think, than execution risk on this business. The borrower, to be honest, hasn't been very proactive communicating with us, so we had to appoint. And we are now in the process of recovery. But to give you an idea on this loan, which has been already now had an offer accepted, we had 7 offers accepted. Sorry, not accepted. We had 7 offers above what was due to us, and 2 of those offers were at double the capital due.
Right.
So clearly the recovery process, which is the first time it happens, it's 1 in 61 loans. Basically, and in terms of capital was like 1% of what we've less than 1% of what we've lent to date. It looks like we're gonna have an easy recovery because I mean we have 2 offers at twice the capital outstanding. So clearly that went well. That has demonstrated, and the offer accepted is actually just like 5% above the valuations we had when we did that loan. So bang on, everything was really in line with what was expected. Now, what you said about the business and having enough defaults, when you said we don't have enough loans because we have a lot more lenders, we gotta be, to me, it's something, I know lenders want small deals, but one thing we're gonna be tough, we gotta keep the due diligence level we do, and we're not gonna make our credit policy lighter, and everything's gonna remain the same because 1, we don't want default for our lenders, but 2, we don't want default for the business as well, because then it becomes a lot of extra work and cost potentially. That is, I mean, it's a pain to do, right? Nobody enjoy working in a default scenario. So,
Sure.
So by keeping our default rate low, for sure, it makes our life easier as well. So we're always looking for good risk reward opportunities. But I think today there's a proper risk premium on the deals we do. Like, I don't think, because the loans, the SME loans are struggling to get funded, I think the SME property developers today are paying too much to Access Finance. And I think creating this platform, bringing more and more capital to the market, is probably going to compress the rates in the next few years. And that's very possible. Now, in terms of default, do we have process? Of course, we have process in place. The first is to make sure we select the good deals. But then, when you have a black swan like what happened last year, there's nothing. You're gonna have some, so you can have some defaults, and you gotta make sure you have the right process. So, what we talk a lot is about doing the due diligence and vetting the deals. But second part, very important, and I don't know if your private investors are doing themselves because it takes time, is the monitoring of the loan. The earlier you find out there's a problem, the higher chance you can find a solution and solve the problem. So it happens that the development may overrun on its cost, so it's delayed. But if you pointed this out early, you can bring easily solution. But if you don't communicate with your borrower and you find that the day you're supposed to repay, then you can be in a bad situation. Same as on development, we don't give the money up front. We have QS report who are producing monitoring certificate. We review the certificate, and then and we pay them. If you are giving too much money up front, you can end up being in a bad situation. So there's a lot of work first to do to make sure you reduce the amounts of default and keep your loss to zero. There's a lot of work you gotta be doing before you get to that. Now, let's say you get in the extreme case scenario where things went bad. We have our process in place, but we're not always going to follow the exact same route. It depends. It's going to be case per case. We're going to review the options, what we can do, and we're going to execute the best way to recover the money. So sometimes it might be better to give an extra month or two to the developer to finish it and selling it because it's in process, or it's going to be stepping in. I mean, we've been lucky. Literally, we only had one default. So that's our main goal, really. But you got to make sure if thing goes wrong, you have a strategy in place to get the best outcome. And that's what we do.
And that enforcement process, you guys are running the process. You're spearheading the process because, correct me if I'm wrong, Yann. I think that there are two structures or models that you can operate when it comes to peer-to-peer lending. One is the direct lending structure or direct investment structure. The other is the indirect structure. And I think you guys operate the direct structure. In other words, the lender has a direct relationship with the end borrower, and you guys are acting as the platform. Some other structures where the platform acts as the agent, so you're effectively lending to the platform, and then the platform then lends to the end borrower. Is that right?
Correct. Yeah. So exactly, we perform the direct, as you said, if you the direct way, if you can call it that way, where lenders, what we do is we do syndicated loans, where technically we have a security trustee entity that signed a contract with the developer on behalf of the syndicate. So the board doesn't see all the investors; it just deals with the blend, but the lenders sign contracts directly through the syndicated loans with the borrower, and that's not for, I would say, it's not to mitigate risk on default of the loans, but on, hopefully not, but like on credit risk of the platform. If a crowdfunding platform went bust, you want to have the tools in place to make sure the platform can be operated and recover the money, or just run the deal till expiry, even if they are performing on behalf of the lenders. So we have in place a resolution compliance, which is pretty much a wind down document that basically show how to operate the platform at every aspect from to be able to. So it's a wind down plan, is to make sure what is the plan, and we have the sufficient fund in place to operate this platform till all the loans are repaid. And if things gets worse and the platform is insolvent, we have what's called a backup agreement. So another operator who operate the platform on behalf of the lenders till all the loans are repaid. There's no scenario where the lenders have to basically step in and start selling the assets themselves. And that's what we do to secure.
Yeah, and I think that's a very important consideration. I think when you're not covered by the financial compensation scheme, and you're lending through a platform, and the platform is relatively young, and it's not just Blend. Most crowdfunding platforms are young. Except for the likes of Seeders and even I think Crowdcube, who actually, interestingly enough, going through a merger process at the moment, and Crowdcube has actually said, if we don't end up merging, then one of us, or is probably end up going to fail, given that they're so well established and been around for quite a few years, longer than a lot of UK property crowdfunding platforms. That's an interesting comment. So the risk, of course, just coming back, is it's a young company. You haven't been through a complete cycle just yet, and so what happens in that situation. But the flip side is, excuse me, individual lenders don't appreciate or don't recognize the risk of enforcement and the cost of it, and so if you actually go through a platform, the platform will help you to leverage and enforce that risk. But then the risk then becomes, well, what if the platform fails? And so that direct lending structure helps in that way from a legal perspective, because you are now the direct lender with the borrower, and you have the help of the agreements that you have got in terms of a representative, compliance representative with resolution compliance, I think, and they will then step in, and touch wood, if in the worst case scenario, Blend has a problem or has a failure, then resolution compliance will then step in and enforce those obligations between the lender and the borrower, and therefore makes the whole situation a lot safer rather than an unregulated lending scenario.
That's why you were asking, one of your first questions was like, oh, you started in 2016, but you're only really starting trading in 2017 or even January 18. And before we did our first deal, we had to put all those things in place. And I explained why there's a lot more work behind the scene that we've done to set up, that we have set up initially to operate. And I don't even know if every lenders appreciate that all those systems are in place, but we think it's very important to give comfort and to make sure lenders could be repaid in every scenario, basically. I mean, cannot guarantee it, but that's what we're trying to mitigate everywhere to maximize that.
Sure, and I fully appreciate that. I think because I'm a lawyer, I'm trained to look at the worst case scenarios. That's what clients come to me for,
true.
and they say, make sure that we're protected in the worst case scenario. And that's one of the things that I look for. A lot of people think, unfortunately, that it's a very negative way of looking at things. But I think if you don't prepare for the going back to that black box thinking, if you don't prepare for the worst case scenarios, then when they do come around, and in business, unfortunately, worst case scenarios do come around. You can do your level best to prepare, but sometimes those bad situations do come around, and you don't want to be surprised. That's why you want to have a contingency plan in place. You want to have the infrastructure in place, and by lending through the crowd, or borrowing through the crowd as well. If there is a difficulty, you don't have 50 or 60 individual lenders to contend with, or a really huge bank that is just interested in their corporate process of enforcement and not willing to speak to you. It's no good. So I think this, is a much better way, both for lenders and for borrowers, to raise funds, and So, Yann, you've been very, very kind with your time. Is there anything else you might want to just add for my audience, just to wrap up our conversation?
No, I mean, I guess anyone, I don't know if you have anyone in the audience who are property developers or lenders, feel free to register on Blend. It costs nothing. And then if they have any questions, we are peer-to-peer, but face-to-face, I like to call it, even if in current environment it's difficult. Pick up the phone and speak to us. We are real people behind the platform. We're happy to help anyone if they're interested in lending or borrowing. Really, yeah, we believe it's a great model to help everyone connecting with each other, really.
Perfect. Thank you very much. And I'll link through to your website and contact details in the show notes and also in the links below. So feel free to get in touch with the Blend Network. And thank you very much again, Yann.
Thanks, Eric. Thanks, everyone.
Cool.